Imagine waking up to a world where your investments could swing wildly overnight. What if a single auction could calm the storm in global markets? That's exactly what happened recently when a Japanese government bond sale brought some much-needed relief, stabilizing the US dollar while the yen faced fresh pressures. But here's where it gets controversial. Is this just a temporary fix, or could rising interest rates spark a broader economic showdown? Stick around, and this is the part most people miss: the underlying tensions that might reshape how we think about currencies in 2025 and beyond. Let's break this down step by step, starting with the basics. On Tuesday, the US dollar maintained its position as a safe haven currency amid a backdrop of jittery investor sentiment. This followed a dramatic sell-off across stocks, bonds, cryptocurrencies, and even the dollar itself on Monday. What triggered that panic? Well, comments from Bank of Japan Governor Kazuo Ueda hinted at the central bank weighing whether to increase interest rates at their upcoming meeting. For beginners, interest rates are basically the cost of borrowing money, and when a major central bank like the BOJ even whispers about hiking them, it can send shockwaves through global markets. In this case, Japanese two-year bond yields surged above 1% for the first time since 2008, and that ripple effect spilled over into international bond markets, causing widespread tumbling. Enter the hero of the day, a successful auction of 10-year Japanese government bonds, often called JGBs for short. This sale attracted robust demand, the strongest since September, which helped quell the nerves. As a result, the dollar gained a modest 0.1% against the yen, reaching 155.72. Even longer-term Japanese bonds bounced back after hitting new highs in yields earlier that morning. The auction outcome seems to have instilled a bit of confidence back into the market, noted Shoki Omori, chief desk strategist at Mizuho in Tokyo. It's a great example of how government debt sales can act as a barometer for investor trust. When demand is high, it signals stability, much like a well-attended garage sale, where everything flies off the shelves, reassuring sellers that the economy isn't as bleak as feared. But let's not forget the broader context. Monday's chaos was amplified by disappointing U.S. manufacturing data. The Institute for Supply Management's ISM manufacturing index fell to 48.2 in November, down from 48.7 in October. For those new to this, an index below 50 indicates contraction, meaning the sector is shrinking rather than growing. This marked the 9th straight month of decline, with new orders and employment also weakening. On top of that, input prices climbed higher, partly due to lingering effects from import tariffs. It's like a puzzle where rising costs are squeezing businesses, leading to less production and fewer jobs. This points to a slowdown in economic demand, explained Brian Martin, head of G3 Economics at ANZ in London. He went on to advocate for the Federal Reserve to cut interest rates not just in December, but to continue reductions into 2026, potentially up to an additional 50 basis points. Fed funds futures now suggest an 88% chance of a 25 basis point cut on December 10th, up from 63% a month ago. This pessimism about U.S. demand is fueling expectations of rate cuts, which could make the dollar less attractive as a strong currency. Interestingly, swaps markets now price in about a 70% likelihood that the Bank of Japan will hike rates by 25 basis points on December 19th. Analysts from DBS highlighted how firmer bets on both a Fed cut and a BOJ hike might actually strengthen the yen by showing Tokyo's commitment to stabilizing it. And this is the part most people miss: the delicate dance between central banks. If the Fed eases up while the BOJ tightens, it could create imbalances that benefit some currencies over others. But here's where it gets controversial. Some economists argue that aggressive rate hikes in Japan might backfire, stifling growth in a country still recovering from decades of deflation, much like trying to fix a leaky boat by adding more weight. What do you think? Is the BOJ's move a bold step forward or a risky gamble? Meanwhile, the U.S. dollar index, which tracks the greenback against 6 major currencies, hovered around 99.441, slightly up after a week of losses. Global bond yields ticked higher as input prices rose, but the U.S. 10-year Treasury yield dipped 0.8 basis points to 4.0865%, showing a slight rebound from Monday's sell-off. Looking at other currencies, the euro held steady at $1.1610, even as peace talks in Ukraine dragged on. European leaders showed support for Ukrainian President Volodymyr Zelensky after a U.S.-backed proposal that leaned toward Russia, while a special envoy traveled to Moscow for further discussions. Sterling strengthened 0.1% to $1.3217, nearing a one-month high, amid drama in the UK, where the head of the fiscal watchdog resigned after prematurely leaking budget details. The Australian dollar rose 0.2% to $0.6553, and the New Zealand dollar stayed put at $0.57264. In summary, while the dollar's stability offered a breather, the yen's weakness underscores ongoing market fragility. This situation highlights how interconnected global economies are. Like a global game of Jenga, where pulling one block, like interest rates, can topple others. We've seen strong JGB demand provide reassurance, but with manufacturing data signaling slowdowns and potential rate shifts on the horizon, investors are rightfully cautious. But here's where it gets controversial. Could these developments actually benefit emerging markets by making the dollar less dominant? Or are we headed for more volatility as central banks play catch-up? What are your thoughts? Do you agree that the Fed should prioritize rate cuts to boost demand? Or should they hold firm to fight inflation? Share your opinions in the comments. Let's discuss whether this is a sign of recovery or just the calm before another storm. Reporting by Gregor Stewart Hunter. Editing by Murali Kumar and Antharaman.